Wow, that is Chefchaouen in Morocco. We're gonna do our walk here today. Okay, so when I shot the custody in an hour video, actually never thought there'd be a second video. I shot it because I wanted to signal to my engineers, you guys, that you need to understand the businesses that you support deeply, all the boring details, because as I've always said, knowing the business better than your business partners is the only path to providing business value and the most powerful path for engineers to the C-suite, to become a CIO or start your own company. So I still believe that, obviously, but I'm making the second video because I have an hour to walk without the family here in Morocco, and I also don't want any of you to think narrowly about the business functions that you support. Just so I'm being super clear, if you're an engineer, you have to understand the details of the businesses and business processes that are upstream and downstream to the one that you support. You are not some API that's agnostic to the inputs you get from the engineers upstream and agnostic to the outputs you give to the engineers downstream. Your path to engineering mastery isn't just about being full stack. You have to have an encyclopedic understanding of the end-to-end business process to be able to walk from that external client, even that client's client, every step of the value chain, end to end, through every business and business function, whether it happens in your company or not, all the way back to that client, the one who's, paying your mortgage. Okay, enough preaching. So I usually shoot these videos back in the US during my lunch walks, and I usually sweat a lot. But today I'm doing it while on my vacation here in Morocco. So if you don't want to see me sweating bucketfuls, just focus on the audio. On today's walk, I'm probably going to suffer from heat stroke. And more importantly, I'm going to try to explain fund accounting, business value that's downstream from custody, but deeply reliant on it. I'll probably touch very briefly on a business function called transfer agency, but that business really needs its own, delirious walk in the desert. So before I get to the main course, the accounting part of fund accounting, let's ground ourselves in the fund part. Let's answer the question, what is a mutual fund? And we can do that by pretending like we're gonna start our own. Before I get into it again, that is Chefchaouen. Oh my God, it's so beautiful. It's called the Blue City. Okay, so a mutual fund is it's a type of investment that pools money from many different investors to purchase securities. If you don't know what securities are, just watch that first video. These investors can be like individuals, businesses, or other organizations. Mutual funds, they offer investors three distinct advantages, and we're going to walk through all of them just so we're all clear. They are professional management, which I'll explain in a second, diversification, and economies of scale. So the benefit of the first one, professional management. When you invest in a mutual fund, you're giving your money to professionals who will manage it for you. The people behind the fund have years and years of experience in the financial world and know how to invest money in a way that'll give you a higher probability of making a profit, at least when compared to the average person, dabbling in investing. In addition, the people behind the fund will also be responsible for creating all of the doing all the paperwork. That's part of a business called fund administration, which I don't think I'm going to cover. And they end up also paying all of the associated fees, which we're going to hit on shortly, that make it difficult for small investors, you, me, to get started in this market. So that's professional management. That's the first benefit. The second benefit was diversification. And that means that your money is spread out among many different investments. Think stocks, bonds, options, futures, which reduces the risk that you'll lose a lot of money if one of those investments fails. So diversification helps manage risk, essentially. If you own only 2 stocks, that eliminates 46% of what's called non-market risk of owning just one stock. If you own like 4 stocks, that risk is reduced by 81%. Your personal ability to reduce risk after that requires that you do a ton of work, which most people don't have the time to do, or the training to do for that matter. So if you had 16 stocks in your portfolio, you're at 93%, and with 32 stocks, non-market risk would be reduced to 96%. After that, you have to jump to 500 stocks to achieve 99% non-market risk reduction. And who has the time for that? You know that one uncle who keeps telling you to buy Google, which isn't even called Google anymore. It's Alphabet. Well, ask him for another 15 good stock picks. Watch his eyes light up, because he probably can give you another 15. But then, to throw him for a loop, ask him for an additional 485 and tell him to Google non-market risk reduction. So anyway, only other point on diversification I want to cover is that traditional mutual funds, they don't hold alternative investments like real estate, precious metals, hedge funds, private equity. If you're BlackRock, they have a class called infrastructure. If you need that level of diversification, you probably shouldn't be watching a video about fund accounting. Just know that is a thing. It's called an alternative mutual fund, and it gives you even more diversification and higher fees because they're harder to manage. So we covered professional management and diversification, points 1 and 2. The other benefit of a mutual fund is essentially economies of scale, right? You buy into, let's make sure I don't get hit. You buy into a mutual fund because when so many people invest in them, the cost of actually running the fund are spread out among those people. This makes it cheaper for each individual investor, and it also means that the fund is more likely to make a profit or higher profit than they would otherwise. The industry's better stock pickers become the best mutual fund managers because they have a lot of experience and know how to choose good investments. I say better, well, because they're, in my opinion, they're not the best of the best, because if they were, they'd probably start their own hedge funds, but that's beside the point. Fund managers have more knowledge about stocks and the stock market than you or me, and that helps them make smarter decisions about where to put your money. So let's pretend that we're going to start a mutual fund ourselves in the States. To start one, we'd need to file some documents. Let's start with the basics. We'd have to file them with the Securities and Exchange Commission, the SEC. These documents would include things like the fund's prospectus, registration statement. Let me explain. A prospectus provides information about the fund, including its investment objectives and strategies. The registration statement includes information about the fund's management and financial statements. We'll also need to establish a bank account for the mutual fund and hire a transfer agent, which we talked about earlier, to handle shareholder transactions. The transfer agent would maintain records of ownership and distribute dividends, other payments to the shareholders. we'll need an investment strategy, just for fun. Let's make our investment strategy to copy the stock buys and stock sells of members of the U.S. House of Representatives and the U.S. Senate. Why? Because members of Congress have a legal but wildly unethical opportunity to use their access to privileged information to help them make smarter decisions about where to put their money. That needs to end. They can also influence the stock market by drafting legislation or blocking legislation, or even making statements about certain stocks or industries. This gives them an unfair advantage over regular investors who don't have access to the same information or the same power. So that'll be our investing strategy. We'll choose the stocks they're putting their money on, and our fund's investment objective, because we have to articulate that for the documents we need to file, will be to have Congress serve the lowly investor, even if they're doing it unintentionally and unethically. So, the 3 most common stock picking strategies, and we didn't pick any of these, but let's walk through them real quick as we're covering mutual funds. 1 is value investing, and we'll go into each of these quickly. 2nd is growth investing. 3rd is momentum investing. Value investors, the first one, look for stocks that are undervalued by the market. These stocks may be like out of favor or have fallen in price due to some kind of negative news or poor performance. Value investors believe that eventually the market will recognize the true value of these stocks and prices will rebound, right? So think Warren Buffett, value investor. Second group was growth investors. Growth investors focus on companies that are experiencing rapid growth in revenue and earnings. They believe that these companies will be able to grow their profits at a faster rate than the overall market, providing investors with above average returns. Think Peter Lynch, growth investor, right? Momentum investors, the third group, they look for stocks that have been like rising in price recently. They believe that these stocks are more likely to continue to rise in price, providing capital gains for investors because of that little dynamic. There are no famous momentum investors that I know, which probably says something about momentum investing. But anyway, we're dodging all that with our congressional strategy and relying instead on how, Congress hurts democracy and free markets. As we're starting a fund, we'll also need to create a prospectus, as I mentioned before. And a prospectus is a document that provides more detailed information about our fund, including its risks and investment strategies. What would be the risks of our fund? Members of Congress picking up some kind of moral conscience, never happened. The prohibitive costs of starting a mutual fund can be a deterrent for many investors. All of this bureaucracy that I haven't even described, and this need for documentation, daily documentation, can be expensive and time-consuming. In addition, if we wanted to start one, we'd need to, in order to launch our fund, we'd have a registration fee, a management fee. We'd have to pay what's called a 12B-1 distribution fee. That's a type of fee that helps to pay for the costs of marketing and selling the fund. All of these fees can add up pretty quickly into a couple $100,000 US. So not for the faint of heart. But let's say we do all of that paperwork, which varies from state to US state, and we pay for all of it. Our customers can now buy our amazing fund directly from us, the fund company, or through like a financial advisor, or even on an exchange, depending on the kind of fund that it is. So, a couple other structural considerations before we get into the accounting part. Let's make our mutual fund what's called an open-ended investment fund. That's a type of mutual fund that doesn't have a set number of shares that can be issued. New shares in that kind of vehicle can be created and sold to investors as you know, demand dictates. Open-ended. That's why they call it that. This makes our fund different from like a close-ended investment fund, which have a fixed number of shares that are issued at launch, and those funds don't issue new shares. So let's make it what else structurally? Let's make it a daily dealing fund. That means our customers can put their money in or take their money out of the fund on a day-by-day basis. There are funds that are not daily dealing, that only allow getting in and out on like a weekly, monthly, quarterly basis. But let's set up ours as daily. It's more convenient for our potential customers when you know, they can invest their cash today and withdraw any day after today. That's not putting down our weekly, monthly, quarterly competitors, because honestly, most investors put their money into a fund for years. It's kind of like fire and forget. Many for, you know, until they retire. So daily dealing funds aren't necessarily that practical. Anyway, the reason we're choosing to make it a daily for this walk is to drive home the value of fund accounting. Fund accounting is good for all the different kinds of, you know, weekly, quarterly, but the daily really drives it home. Because if a customer invests $1 in our fund today, they might want to know how their dollar is doing tomorrow, or the day after, or the day after that. And while most customers keep their money in mutual funds for long periods of time, there will be customers every day that need to cash out for, you know, whatever good reason they have. Another reason why fund accounting matters, really, this one will determine how we get from the total fund value to one customer share of the fund. Let's structure our fund as a partnership, right? Because that means our accounting will allocate gains and losses to our customers' accounts. And on any day, the value of their assets, it's called the net asset value. We'll describe that in great detail as I walk through these streets. So the value of their assets, their net asset value of their accounts, they can be figured out. By the way, what's the alternative to a partnership? If we wanted to structure our fake mutual fund differently, we could structure the fund as a company or as a trust. That would make our offering unitized, meaning what we're selling, which means that investors would be given units or shares in the fund at the time they invest. These shares would have a value, some specific value per share, which would change over time. In this kind of structure, the value per share at the time of our customers' investments determines how many shares they're allocated. Now, obviously, the value per share at the time that they withdraw their cash determines how much they get. So let's go. We were building a daily dealing fund that is a partnership. With those decisions made, let's shame Congress and make our customers love us. Let's bring real customers into the picture who want to buy and sell our fund any day of the week minus holidays. We're now ready to take cash from our customers. Our customers are going to be investing into our fund. Our fund's going to issue shares to those investors and use their funds to make investments in various financial instruments, specifically, Congress's picks. That allows the fund to earn income. This is important because we're starting to talk the language of accounting. To earn income and incur expenses. And the real world value of our fund will be determined by whether we buy and sell the right securities at the right time, or, Congress people do, and how effectively we manage all associated expenses to the fund. So, we're now at the point where we're going to need fund accounting. Long way to go, but this is where we stop, maybe look behind us at where we are again. Just gorgeous. The point of fund accounting is, one, to track the individual investments in our fund. Two, to track how much money each investor has put into the fund. And three, track how much money the fund has made overall. This information is used daily to calculate the fund's net asset value, which we talked about before. It's also called a NAV. The definition of a NAV: it is the total value of a mutual fund's assets minus its liabilities. What's in the black minus what's in the red, right? Basic accounting. So the NAV is calculated each day and published in newspapers and other financial information sources. It's important to investors because it's a measure of how well the fund, and therefore their money, is performing. The assets in a fund are broken down into two categories: primary investments and, obviously, secondary investments. The primary investments are the most important part of the NAV. They make up the majority of the fund's value. The secondary investments, as you can guess, are less important, but still play a role in the overall NAV. Primary investments, what are some examples? You got equity investments. These are like stocks and shares in companies. The value of equity investments goes up and down with the market, so their value can change rapidly. Fixed income investments, that's another kind of primary investment. These are investments that give a set amount of money back every month or year, regardless of what the market does. Think bonds. We talked about this in the last video. There's a whole category called cash equivalents. These are investments that can be turned into cash quickly, such as short-term certificates of deposits, also called CDs, like the kind grandma used to give you for your birthday if you're a certain age, like if your baby pictures are in black and white. And anyway, those are primary investments. There's also a whole category called secondary investments, things like derivatives. These are contracts between two or more parties that derive their value from an underlying asset or group of assets. Please don't expect me to make derivatives make sense in a walk anywhere in the world, much less Morocco. They're almost intentionally complex. Easy one would be like a futures contract. That's a kind of derivative that agrees to buy a set amount of a commodity, like oil, at a set price on a set date in the future. Derivatives need a lifetime of walks like this. Anyway, there's other securities that are secondary investments. Think types of investments that don't fit into one of the other categories, like real estate or mutual funds themselves, because a fund can buy a fund of funds. As you can imagine, while the US markets are open, think 9:30 a.m. Eastern Standard Time till about 4 p.m., all of the prices of all of the stocks in our funds will be changing. Fund accounting helps us tell one of our customers how their investment is doing at 1 p.m. Or it helps us know how much to charge for that fund at 1:30. Or helps us to figure out how much to pay out for a customer who wants to cash out at 2. Right? This is where fund accounting becomes indispensable. Why? Because the easy answer to all of these customer questions and requests is to use yesterday's performance, yesterday's pricing summaries. And I'm going to explain each of those things in a second, but that requires you to close out all of your fund's numbers every day, which is why every business day, right after the markets close, the field of fund accounting has the most stressful hour of their lives. It's called the golden hour. And it's during that time that NAVs are struck or calculated. Industry-specific jargon. Why? Well, the easy answer, that's when all of the prices have stabilized. So the golden hour of NAV production is the time after the market closes, when mutual fund companies calculate their net asset values, NAVs. And it's called the golden hour, almost sarcastically, because it's when fund companies have their most accurate information about their fund's holdings. The calculations of a single NAV, it's hard enough, but fund accountants are never employed to calculate just one NAV for just one fund. Imagine the market just closed and you and your team have thousands of funds that you need to cut a NAV for. This process at scale can be incredibly complex, time-consuming, especially since the ambition of you, your clients, their clients, is to produce an accurate NAV, 100% error-free, daily, during this tiny little window of time. But that's why God invented computers. No, it's not that simple, because every transaction for every fund can come with multiple versions of the truth. The fund manager might think that they sold their Apple stock for like $100, but their counterparty might think that they sold it for $98. A ton of reconciliation needs to happen in near real time. One kind of recon would be between the internal records of the mutual fund and the records of the stock exchange where the stock was sold. Another would be between the mutual fund's records and the records of its custodian or trustees. There might be reconciliations between different mutual funds that hold the same stock. As a tech optimist, the key here is that technology is great when every system uses the same golden sources of data. But the financial services industry, as an industry, has a long way to go before we get to that optimistic future. And that's just the complexity on the asset side. Two quick notes about jargon, right? Accountants use a term called capital activity for what we just discussed. It's an industry-specific term for the movement of money into and out of a mutual fund, the buying and selling of assets, the receipt and distribution of dividends and other payments. The term capital activity can also be the issuing or redemption of shares, subscriptions and redemptions, subs and reds. That's like an industry jargon within industry jargon. Accountants also use the words portfolio activity, which refers to the buying and selling of securities by a mutual fund itself. This can include purchasing new securities, like what, those shameless Congress people do. What did they buy yesterday? Or selling existing securities, like what did they dump? Or exchanging one security for another. You also have to incorporate potential liabilities when calculating net asset value. Let's go through these. One, these are the potential liabilities. There's outstanding shares, there's redemption requests, and we're going to cover all of these. There's fees and expenses, there's dividends and interest payments, also called just interest income. The first one was outstanding shares. So outstanding shares are the total number of shares that have been authorized by a mutual fund's board of directors but have not been purchased by investors. Redemption requests, it's just a fancy word for investors are asking for, they're demanding to redeem their shares back, to receive the underlying assets back. That's fancy talk. Customers want to cash out, right? Mutual fund managers must liquidate some or all of the underlying securities in order to meet redemption requests, which can actually affect the price of the securities. Which, by the way, just a quick little note before I cross this very dangerous street. That's why this whole Congress strategy wouldn't work, to be honest with you, because Congress people are smart enough to know that if every time they bought something, we bought something, they'd buy stuff. They would wait for the rising of the prices before, because they're a result of us buying a ton more shares of what they just bought, and then they would sell it before, we can sell it based on their actions. So anyway, it's like Inception. It's like sales within sales within sales, or a dream within a dream within a dream. Anyway, so let's keep going. Fees and expenses. Fees and expenses include like a variety of costs incurred by mutual funds, including like management fees, distribution fees, other operating expenses. In our example of using congressional buys and sells, we might need to pay a small little army of business analysts to keep checking congressional buys and sell orders or their disclosure forms. That's an expense for our fund. All these costs reduce the net asset value of a fund and can have a significant impact on an investor's total return. Fourth and final one, dividends. Dividends are payments made by a fund to its shareholders out of its profits. These payments may be in the form of cash, shares, other assets. And interest payments are payments made by a lender to a borrower in exchange for the use of money, right? These payments typically occur on a periodic basis, such as monthly or quarterly. Vegetables. A NAV is equal to the total net assets over the number of shares outstanding. Let me say that again because it's worth saying again. Total net assets over number of shares outstanding. That's what a NAV is. That might be too high level though, so let's get a little deeper. The numerator of a NAV, that's the top of the fraction, what I just called total net assets, is actually total assets minus total liabilities. In terms of assets, a fund accountant has to account daily for any income, think dividends and interest. They have to account for any trades that the fund manager made that day. They have to account for any related corporate actions. Remember the process I described in the last video? Custody, banking in an hour. Quick note here is that as the accountant figures out the asset story, they have to reconcile cash and stock with custody. I didn't get killed. That means they have to ensure that they have an accurate count of the cash and stock that they're holding. They do this by working with, drum roll please, a custodian. see that last video, who helps to manage and track the assets of the mutual fund. This also ensures that the mutual fund is able to stay in compliance with regulations. So that was the asset portion of the numerator. But remember, it was total assets minus total liabilities. When it comes to liabilities, there's two big ones. The fund accountant has to account for any outgoing payables and expense accruals, the process of recognizing any expenses as they're incurred, rather than waiting for when the payments are actually made. This helps to ensure that the mutual fund's financial statements are accurate and timely. So that was all just the numerator. In our case, the total dollar value of all our congressional funds, stocks, bonds, and other investments minus the total dollar value of all the liabilities. So now we need to compute the denominator, the bottom of the fraction, which is the number of shares outstanding. The fund accountant needs to account for subscriptions and redemptions, which we talked about, fancy industry jargon for who's most recently bought into and sold out of the fund. That factors into the bottom of the fraction. Once you have an accurate numerator and denominator, easier said, actually not so easily said than done, cutting the NAV is basic math. There's one other chunk of complexity that I need to mention when it comes to the numerator. When we talk about total assets, which again is the total dollar value of the fund's investments, we need to know two things: the quantity of each security that the fund owns times the price of that security at the end of the trading day. It sounds fairly straightforward, but the pricing of securities is actually a lot more complex than you think. There's a tool in every financial services company called a security master. It's a database that stores information about all the securities traded on every exchange. This includes the name of the security, its ticker symbol, the number of shares outstanding, other important details. Having a rich, flexible, up-to-date security master is critical for pricing funds. Companies use a security master to store accurate information regarding fundamental and pricing data. Given the complexity in global markets, there might be multiple IBMs, for instance, as a security, multiple prices for that same security, and multiple pricing data providers. Think ICE, Bloomberg, and every fund and every fund board, the governing function on a board, the people who govern it, has their own specific needs and preferences around how to price, and that's built into their contracts with their fund accountants. By the way, quick little break just to show you where I am, because I'm pretty sure I'm lost. Yep, I'm lost. So let me turn around and start walking this way. So, for instance, we're talking about fund boards and how they each come up with their own set of lists of specifics for how they want their fund accounting done. There's something called fair value pricing, which prices a security by looking at how much money you would get if you sold the securities right now, as opposed to when it actually sold like 2 minutes ago. It's a way of protecting against investors trying to game market volatility. So that's an example of why pricing and pricing rules matter, and why, governing boards and funds care, right? A good security master definitely matters. If it's designed well, it can be easily accessed by users and systems across a large enterprise. If it was designed well, it would have multiple types of asset classes that can be mastered with it. Equities, derivatives, bonds, currencies, interest rates, equity options, mutual funds, indices, credit securities. You get the point. It's especially important to master this kind of data to improve operational processes, to optimize companies' resources, reduce overall costs. Why? Because without a security master, you're more at risk of having inconsistent information across multiple systems and processes. You're more at risk of storing duplicate data all over the place. You're more at risk of needing to reconcile your own data, all of which inevitably leads to larger operational expenses, smaller profits. Getting pricing right is about getting risk management right. Businesses need to reduce operational risks. They need to assess and address potential process breaks. Getting pricing right is also about just great trade execution, right? Meaning companies can reduce execution costs, trade fails. They can manage capital expenditures more efficiently. And getting pricing right leads to a positive client experience, happy customers internally and externally. And because it's financial services, happy regulators. Those are all the key parts of your company's profitability. So using and maintaining a good security master, a solid pricing master, leads to more accurate NAVs and better end-to-end decision making. That's my little plug for investing in reference data. As with my, walk for custody, I forgot to mention taxes. I always forget to mention taxes. As with everything money related, taxes are important because they can have a significant impact on an investor's profits. For example, if a fund sells some of its holdings for a profit, that profit will be subject to capital gains taxes. The amount of those taxes will depend on how long the fund has owned the shares, as well as the tax rate applicable to the investor. If nothing else, if we're going to start and run a mutual fund, the fiction we started at the beginning of this walk, or serve that fund with accurate accounting, we need to be deeply familiar with tax implications. And that is a lot of complexity for something as humbly titled as fund accounting. As a technologist, I actually mourn for fund accountants. I feel their pain, concentrated as it is during the golden hour. In the short run, best I think you can do is workflow. Maybe a little bit of RPA, robotic process automation where possible. And most importantly, fix your data supply chain as upstream as you possibly can in your client's shops if you have to, right? In the longer term, as an industry, we just need to fix the root cause behind why there's so much confusion and need for reconciliation at the industry-wide level. Speaking just technically, the reason starts with the fact that every player has their own data and databases. That's why the blockchain, not cryptocurrencies, but the blockchain, provides such a compelling vision for the future. In theory, they become the foundation for a single industry-wide golden source repository. Hope you learned something.